Credit plays a significant role in the management of cash flow within businesses. It refers to the agreement between a business and its customers or suppliers, where payments for goods and services are deferred to a future date. While credit can provide flexibility, both in receiving and making payments, it also requires careful management, as it can have a profound impact on a business's cash flow. When businesses offer credit to their customers, they allow them to delay payment for a set period after receiving the goods or services. This is common in many industries, particularly in business-to-business transactions. For example, a wholesaler might offer its retail clients 30 days to pay for stock, allowing the retailer time to sell the products before making payment. This can attract more customers, as many businesses prefer flexible payment terms over paying immediately. However, while the wholesaler may have made a sale on paper, the cash won't be received until the customer settles the invoice. This gap between making a sale and receiving payment can strain cash flow, as the wholesaler still needs to cover its own expenses, such as purchasing more stock or paying wages. Similarly, businesses also rely on credit from their suppliers to manage their cash flow. Instead of paying upfront for materials or goods, they can receive stock on credit and pay at a later date, typically 30, 60, or 90 days. For example, a small manufacturing company might order raw materials from a supplier and be given a month to pay for them. This delay allows the manufacturer to produce and sell its products before having to pay the supplier. By effectively using supplier credit, the company can maintain a smoother cash flow, even during periods when cash reserves are low. However, while credit can be beneficial, it also carries risks. Offering credit to customers may delay the inflow of cash, and if customers fail to pay on time, it can lead to cash flow problems. For instance, a construction firm that allows clients to pay in installments may face cash shortages if payments are delayed. Even if the company is profitable and has a strong pipeline of work, delayed payments can prevent it from paying its own bills, such as wages or supplier costs, on time. This is why many businesses establish clear credit policies and conduct credit checks on customers before offering credit. By assessing the creditworthiness of potential customers, businesses can reduce the risk of late payments and bad debts. Late payments are a common issue in many industries and can have a serious impact on cash flow. When customers do not pay on time, it creates a ripple effect. For instance, if a retail business is waiting on several overdue payments from customers, it may not have enough cash to pay its suppliers, leading to strained relationships and potential supply disruptions. To manage this, many businesses implement credit control systems, which involve regularly monitoring outstanding invoices and following up with customers to ensure payments are made promptly. Some companies also offer early payment discounts to encourage customers to pay before the due date, while others charge interest on late payments to mitigate cash flow risks. On the other hand, businesses need to carefully manage the credit they receive from suppliers. While supplier credit provides breathing space in terms of cash flow, it also represents a liability. If a business does not manage its outgoing payments efficiently, it risks damaging relationships with its suppliers or incurring late payment penalties. For example, a restaurant that consistently pays its food suppliers late may find itself facing stricter payment terms or even being cut off from future supplies. This can lead to operational disruptions and further cash flow issues. To avoid such situations, businesses often track their payment deadlines closely and ensure they have enough cash flow to meet their obligations on time. In some cases, businesses may seek external credit in the form of loans or overdrafts to manage cash flow. For example, a small business experiencing a temporary cash flow shortfall may take out a short-term loan to cover its immediate expenses while waiting for customer payments to come through. Similarly, a bank overdraft provides flexibility by allowing a business to temporarily overdraw its account, giving it access to additional funds in times of need. While this can be an effective way to manage short-term cash flow issues, relying on external credit can lead to higher interest costs and increased financial risk if not managed carefully. In conclusion, credit is a vital aspect of cash flow management in businesses. It allows businesses to balance their inflows and outflows more effectively, providing flexibility in both receiving and making payments. However, credit must be managed with care, as delayed payments or poor credit control can lead to cash flow difficulties. By carefully assessing the creditworthiness of customers, maintaining good relationships with suppliers, and using external credit only when necessary, businesses can use credit to support, rather than hinder, their cash flow.